Well, let's get to our first guest of the hour. I've been looking forward to this chat for a while. Grant Patterson from Providence Wealth is standing by via Skype to go and do a bit of learnings of what we saw this year in 2022 from an investment perspective and what may lie ahead in 2023. Grant, good to go and see you there. To kick off with, one of the characteristics that's really been noticeable this year is that those really bubbly parts of the market that we saw in 2021, talk about the likes of those really hyper growth stocks, crypto, have all unwound quite spectacular this year. What did you make about the price action we've seen?
The only surprise really, David, that I had, and thank you for having us on, the only surprise I had really was that people were surprised. There was clear evidence of rampant speculation in markets fueled by the surging money supply by the central banks. And the valuations just quite frankly were way out of control. So what I make of it is that the speculation in the market has started to dampen somewhat. But I think we've got to, the pretty big falls we're talking about here with, the likes of Tesla down 50-odd%, Meta down 64, what have you. We've just got to put into perspective there's some significant damage done. Those top stocks, the FANGs, if you like, they're down equivalent of $2.9 trillion. Now, that's the same as the total market cap of the Australian market. So there has been some real damage done there, and I'm not yet convinced that we've seen the bottom of these markets, despite the recent, we'd say, technical rally.
Okay, so Grant, let's go and delve a little bit deeper there, because a lot of markets participants are starting to get quite excited about the prospect that, despite all the hawkish rhetoric from central banks, inflation will come down quite rapidly next year, and that will lead to the pivot. Do you think that's a baseline scenario, or do you think that's a little bit wishful thinking at this stage?
I won't say fool's paradise, but I think it's wishful thinking. The inflation rate has definitely peaked, and we're going to see that decline. And that's not surprising from a peak rate of 9 or 10%. So the inflation narrative will see expectations of lower inflation, and that's likely. But I'm not convinced we're going to see a pivot from the central banks at this stage. They remember only too clearly how long it took to get inflation under control out of the 70s, and the market seems to be very benign of the view that we're just going to see a slowdown, the Fed will stop raising interest rates, inflation will come down, growth will rebound, and we're back to the same events that we had basically over the last 30 or 40 years, which were very positive. I'm not convinced we're going to see that. And the area that concerns us most, in a sense, is the realisation that earnings are going to really struggle next year as we go into a deeper recession in Europe, a mild to modest recession in the US, and the markets are still expecting earnings to hold up. I don't believe that that's going to occur.
All right, so in an environment like that, so we have a growth downturn, a recession, we have still high interest rates in environment. As an investor, it's a pretty tricky environment. Not a lot of people have had to go and deal with this, in recent decades. When you look towards next year, how are you going to see where the other opportunities lie in such a difficult environment?
Well, as negative and cautious as we are, and we're still remaining very diversified with high levels of liquidity, we believe that there will be still some further disruptions in markets, and we'll see valuations come back quite sharply in certain sectors, particularly in private markets, where the reality of what listed markets are telling you hasn't been forthcoming in regards to valuations. But from our perspective, we're getting quite excited about the opportunities that are likely to come up after we get further disruption. And so those areas are distressed credit. We're keeping an eye out there on the managers that we'd like to employ in that sector. Secondaries in the private markets, once they've had the realisation of the revaluation down, look quite interesting. And perhaps once the markets, and we believe that the US market is likely to retest previous lows, some of the small cap companies we think were going to look quite attractive. So we've got to be nimble and keep our mind open to that. But we do believe that there's further downside to markets from these levels where we've really only had in our view, a technical rally. We haven't really seen a valuation change given the outlook for earnings next year.
When it comes to that private space that you talk about and the mismatch in valuations to what we're seeing in the public sphere at this point in time, how long does it take to go and play out, do you think, next year? Do we actually go and see some distressed sales and a realisation that what we're seeing in the public sphere has to be eventually reflected in what's going on in private valuations?
Well, it will. There's always a lag. And I think the regulators are starting to have a look at this in regards to how some of the larger super funds manage or smooth their returns, which is at a disadvantage of new members or new money coming into the fund. So the regulators are going to start looking at, I think, a standardised valuation metrics. But as I say, there's always a lag. I mean, the obvious one is in commercial property space. The listed property trusts are down quite sharply, implying a cap rate in the order of 7% on the listed market, yet the private markets are still valuing commercial buildings like the one behind me, at cap rates of 4.5, 5. So that's an obvious arbitrage, if you like, in regards to valuations that are still sitting in the background.
Just to go and finish off, Grant, you mentioned the US small caps that you're getting quite excited about the opportunities that are likely to arrive at some point next year. When you can look into that universe, what are some of the sectors that you're getting more excited about the prospects once it occurs?
Well, I think we still have gold in the portfolio as a steadier for the portfolio, as a bit of protection. As you know, David, only too well, my views on cryptos over the years. Gold is the real area that protects the portfolios. Cryptos really are just a plaything. So we're not too excited there. We do believe that Australian government bonds represent good value at these sort of levels. Previously it was, the old thing that there is no alternative when interest rates were so low and bond rates were so low. Well, there is an alternative now. You can get 3.5 or 4% out of an Australian government bond that we think looks quite interesting as a sector, if you like. Equities, we believe it's too early. We don't mind some of the direct property sectors, more the niche areas still, and we've been playing that for a while. Regional hospitality, agriculture, specialist disability housing looks quite exciting for us. And private markets, as I mentioned, as an asset class at some stage, once we see the revaluation down. So, there's a change of regime. We've had 30 or 40 years of declining interest rates. We've had the Fed put. We've had globalisation, positive demographics, very strong liquidity. Well, I think the next few years is going to challenge that, and I think that'll be very challenging for the people in the markets that have been used to buying the dips, because that doesn't always help. And as I remember in the 80s, when I first started in the markets, in 1980 there was a decade of no returns. From 1970 to 1980s, the markets were flat, but there was 60% rallies during that period of time, and that was the beginning of the fighting of inflation, interest rates at 18%, and that's when I think I got retrenched after 2 years in markets. It's a real grind, but the opportunities will come. We just need to make sure that we keep an open mind to some of these assets that are going to become quite cheap.